Topic for today is, should I take CPP and OAS as soon as it's available? A little bit about my background very briefly. I was a financial advisor for over 12 years and then went into the fee-only model about 3 years ago. This is to help people have an improved life, give unbiased advice, and I absolutely love working on strategies with clients. Questions like CPP and OAS are one of those topics that there is not a clear answer for everyone. That is one of the draws to this type of work. Financial planning is 6 areas. It is not just retirement planning, it's not just your investments, it's all of these areas, looking at them to see how one thing interacts with another. The CPP and the OAS decisions actually touch on all of these areas. It impacts how much money is going into your bank account. It impacts investment decisions because you may be drawing down investments if you're delaying CPP and OAS, and if you're not delaying them, your investments are growing in that time frame as well. Risk management, you don't know how long you're going to live for, so the decision about CPP and OAS, it's a bit of a risk. If you delay it too long and then you pass away in that time period, you may not have benefited as much as you could have had you lived longer. It affects your taxes. You could have the OAS clawback. The CPPs and the OAS are both taxable incomes, so it definitely impacts your taxes. Retirement planning, of course, and estate planning. The amount of money left in the end when you do eventually pass away, these decisions have an impact on your estate plan as well. First of all, we'll talk about what OAS is. The title is not the best title. It's called Old Age Security, but no one feels old at 65. Old Age Security, it's based on residency, not employment. You don't have to have worked, nobody contributes to it. It comes out of the government general revenues. It's taxable. It's not flexible at all. There's no income splitting. You either take it or you don't. And then when you take it, that's it. That's the only decision you have to make. It's indexed to inflation and it's paid for life. So this part is good. When a lot of people don't have pension plans from their employer, they're relying on their investment income. So a lot of people feel a little bit uncomfortable about planning all of their income just with their investments, that to have this base level of income that is guaranteed for life and is indexed becomes one of those things that people actually like to have. The full pension is $613.53 a month right now. It adjusts with inflation along the way, and it's based on your previous year's income. Oh, sorry, for the clawback, I'm getting ahead of myself here. You have to be age 65 or over, a Canadian citizen or a legal resident, resided in Canada. If you've lived in Canada for 40 years, you'll get the full benefit. If you've lived in Canada less than that, 10 years, think of it like 10 years out of 40, that's a quarter, you would get 25% of the benefit. If you were 20 years out of 40, you'd get 50% of the benefit. So just take the number of years you were a resident or citizen in Canada, divided by 40, multiply it by the benefit. If you're born before July 1st, 1952, you may still qualify for the full pension. There are a couple other little restrictions for that one, but what I would say for the OAS is if you don't qualify for the full benefit or think that you don't, check it out to see if there's an exception in your case or in your situation. If you worked outside of Canada, depending on your situation, like armed forces or working for a Canadian company, things like that, those years still will count as a resident of Canada. If you become a non-resident, you still may qualify to receive the benefit. If you've lived in Canada for 20 years after you've turned 18, and again, those exceptions are in there, and then you left the country, maybe moved to Florida forever, you would still be able to collect your pension benefit. If you were only in Canada for a much shorter period of time and you don't qualify, you still could qualify for your partial benefit here, and then 6 months after you leave, you can still collect that benefit. The OAS clawback, this is what everybody is concerned about. It's also called the OAS pension recovery tax. Your net income, once it's above $79,054 for 2020. So basically there are thresholds. There's a minimum and up to an amount where it's all clawed back. So after you get over that minimum amount, they will take 15% of any amount over that amount. So let's say you earned a little bit more, it's just 15% of that little bit over the threshold that they will take back from you in a recovery tax. It's based on your net income. So net income is calculated after certain deductions. And one important deduction to make sure that you know about is the RSP contribution. If you find yourself in a situation where this actually happens more often than not, people will start collecting OAS not really understanding about delaying it and not understanding the benefits of delaying it. And they still may be working, and then they find they get this check from the government, and then all of a sudden they're taxed on this amount that they got. And it could be all taken back. So to be hit with the full amount of your OAS at tax time, not knowing that you were in that situation, is very frustrating for some people. And to fix that problem, because once you've started OAS, you can't stop it unless it's within that window of 6 months. But once you've started it and that you're in this situation, if you still continue to work and you have RSP contribution room, making an RSP contribution could reduce your net income to a level where you would still be able to collect the OAS fully, not have any of it clawed back. So that's something to be aware of. The CPP, Canada Pension Plan, is a government pension plan based on contributions. It's mandatory, you don't get a choice, and it's designed to replace up to 25% of your income up to a certain amount. So based in 2020, 58,700. So the maximum would replace 25% of that number. This is taxable. I should also mention here, the CPP also has an enhanced program now that they're starting, where they are basically adding an additional amount for people earning at a higher level. That's not in here, but that is in there. It's taxable. There is a splitting option for couples. It's indexed to inflation. It's paid for life. The maximum pension is $1,175.83 a month for 2020. Based on contributions to the plan and a number of years in the plan, there's a formula for that. We're going to talk a little bit more about that a little bit further. There are dropout years, meaning in this formula, it's based on in what relation you were up to the maximum. So somebody that were at the maximum, they earned over 58,700. They were always at this amount that was determined each year all the way along after age 18. They would be at the maximum. So a lot of people have, in their early years, they may still be in school or just starting out a new job. So their income may be quite low. They have this dropout provision where you can drop out 8 years, and that doesn't factor into the formula, because if it was, you'd have these years where you've contributed maybe 10% of the maximum, and when you average it all out, it drops down your payment. So by dropping out those years, let's say you maxed it out for your whole life, and it was after age 26 that you did that, for between 26 and 65, being able to drop out those bottom 8 years, you're able to collect the maximum benefit. You also, if you have had children in that time frame, you can drop out the years where a child is under the age of 7. It's typically the parent that receives the child tax credit. In those years, it actually works out really well, because then if you have, a lot of people will have their kids close enough together that it'll be starting in 1 year, and it could be 10 years that they're able to drop out if they're lower earning years. So that is one very good thing about the dropout provisions. Contributions to the plan. Contributions, as everyone has probably seen off their paycheck, are contributions to the CPP. So your employer puts in 50% and the employee puts in 50%. This amount has actually increased again in 2020. It's now up to $2,898 for each. Self-employed people have to pay both portions, but 50% of the contribution is deductible as a business expense, as it would be, for example, with an employer. That company is paying it and deducting it as a business expense as well. The CPP pension sharing is not the same as income splitting that is done on your taxes in retirement. CPP has their very own system for this. If both are age 60 or over and both have applied to the CPP retirement benefit. So how they calculate, it's not a straight 50-50 split. You don't add them both together and divide them in half. It has to be within the time frame of the credits of when the person was living together or married. So that information goes on an application form when you apply. You say, I want to pension share, and I want to pension share with my spouse, and this is when we started living together, or this is when we were married, and then they will calculate what that percentage is. If you were divorcing, you can split the credits in the time frame that you were married or living together. Someone divorcing, a lot of people actually are not aware of this, and either party can make application to CPP to credit split. It only takes one person applying to credit split. You don't need the other person's permission. You get divorced and you figure out, was I earning much less during the time that we were together and it was below the maximum pensionable earnings? And if so, it would be a benefit to you if your partner was maxing it out to even out those credits. So that helps to bump up retirement income later. A lot of times what happens is one stayed home. If their income was very low in those years and then they get divorced, they have the option of credit splitting, but some people will say, but why would I credit split if I can drop out those years anyways? There's also a disability benefit. So that would be something to keep in mind in those years if that was the situation, that you want to make sure that you at least have that benefit available. When you pension share, the money actually goes to the other spouse. So if you're giving up some of your CPP amount to your spouse, you are actually giving them that money. You don't have control of that money. It's theirs. It's taxable to them. And the only thing that can stop it is separation, divorce, death, or both signing to agree to stop it. Once it's stopped, the payment reverts back to what it would originally have been. The CPP also has a taxable little death benefit calculated at 6 months of your retirement benefits up to $2,500. I don't think they've changed that in many years. It is not indexed. There are also survivor benefits and child benefits. The survivor benefit can be paid with a retirement benefit. So you could be collecting your retirement benefit and then your spouse passes away and then you receive survivor benefits. This is something to keep in mind and is also one of the things to factor in as to when you decide to take the CPP. You can only, with that survivor benefit and your retirement benefit, go up to the maximum retirement benefit amount. So if you both waited or delayed and you're both at the maximum, if one of you passed away, there is no bump up in payment because of a survivor benefit. It's a factor, it's not a major factor, but something to think about in when you're thinking about trade-offs between one or the other. Post-retirement benefits cannot be shared. These are the contributions made after you start your pension, but you continue to work. Let's say you decide to start your pension at age 60 and you keep working and you have to make contributions between 60 and 65, and then have the option of making contributions between 65 and 70 when you're still working. But in that, every year that you make contributions, you get a little bump up called a post-retirement benefit added to your CPP retirement benefit. Important changes happened in 2012. There were 4 key things that happened and they were phased in until 2016. So that's what we're going to look at. And this is why if your advisors or friends or somebody was looking at this prior to 2012, they might make a different decision than they would make after 2016. And you will see why in, I think, the next slide. The post-retirement contributions were made mandatory if you work between 60 and 65. So this change happened in that time frame. Prior to this, at age 60, you could stop working for 2 months. You could start collecting your retirement benefit. And then in that time frame between, let's say, 60 and 65, you wouldn't have to contribute to the CPP. So you're able to save that couple $1,000s a year that you were paying into CPP if you chose not to. So they make it mandatory now that you have to pay into it, and so does your employer. They did away with the rule that said you had to stop working for 2 months before starting your pension. That was just a silly rule. It was easier for some people to do that and then more difficult for other people to do that. So they did away with that rule. They increased the years that you can drop out the calculation of benefits from, so that's where we went from 7 years of a dropout now to 8 years of dropout. And the biggest change and the most impactful is the reduction of the benefit if you start earlier. If you start your retirement benefit before age 65, you were penalized more. And if you delayed it, there was an extra incentive for delaying it. And this is the chart that shows that. Prior to 2012, if you took it at age 60, it was only decreased by 30%. Now it's down 36%. Prior to 2012, it only increased by 34.2, which is still a significant increase, but it's now 42%. So that change right there made a significant difference. The crossover point, if you took just these straight amounts of money coming in payments, so don't add in inflation or rate of return or anything like that. The crossover points between starting in 2012, if you had started sometime between 60 and 64, it would cross over. You'd be about even at age 76 with someone that started at 65, for example. So at 76, now you've broken even. You've had the money longer, sure, and you could have invested it in that time period, that's fine. But a lot of people were looking at that like, well, 76, 77, not sure what my life expectancy is going to be. I'm okay with taking it early, and that was fine. But now that crossover point is actually 73. And then when people think about 73, almost 74, even though it's only a few years difference, you start thinking, okay, well, if I live to 90 though, that's a much bigger difference. And let's see, let's go to the OAS. So it's just a chart to show the 36% increase if you delay from 65 to 70. And this just shows the clawback thresholds, and that it's clawed back at 15%. How to calculate the CPP benefit. So it is hard to explain how to calculate it, so I'm going to explain it the best I can in a simplified way. You want to get your CPP statement of contributions, and it is, if you log into your My account on CRA, and then at least it previously was, in the bottom right hand side, there's a link to Service Canada. If you log into My account and then go to Service Canada, you don't have to re-log into Service Canada because you've already logged into My account. Once you're in Service Canada, you should be able to see your CPP statement of contributions. When you look at this statement, and I've showed kind of what the statement here would look like, you will see a row of years from when you're 18 until now, a list of contributions, and your pensionable earnings. And what you focus on is actually your pensionable earnings more than anything. And in the first row, you'll see 1982, 268.20 in contributions, pensionable earnings 16,500, but there's an M beside it. When there's an M beside it, that means you're at the maximum. On your statement of contributions, if all of the years have an M on them, and except for those early years, maybe 6 or 7 early years, or maybe even 8 early years is fine, that don't, you would be at the maximum. Then if all your other earnings up until retirement are at the maximum, then you can expect to be at the maximum. Each year, you are a certain percentage of the maximum. You might be 90% of the maximum, you might be 50% of the maximum. So if you think in terms of that, you're able to kind of gauge where your numbers would be at. But if you're mostly at the maximum, then you can be sure that you're going to be close to the maximum. So I hope that helps explain a little bit of how it's calculated. And certainly in those, the best way I like to show people how to look at it is print out that statement of earnings. If you have kids that you were the caregiver for that were under age 7, take out those years and put a highlighter around those years. You're going to cross those years out. Then take your lowest 8 years, cross those years out. Now look at your sheet and see if all those other years are at or near the maximum for pensionable earnings. And that's a good way to look at it. Variables to consider to starting the CPP and the OAS. The biggest one is actually longevity. So if you feel like if you feel like everybody in your family passed away pretty young, even 75, let's say, 75, 80, you probably would gear toward taking the CPP and OAS at the earlier ranges. But if you have parents and grandparents that lived in 85, 90, 100, this would lean you toward taking it a little later. The first thing to consider is, do you need the funds? Some people in the lower incomes will need those funds at the earlier ages in order to meet their cash flow needs in that time period. And that's fine. This would be actually someone that didn't have a lot of, maybe they have a very small other pension and they don't have a lot of flexibility in drawing retirement income. So there's not a lot that they can do in order to meet their needs. If that is the case, then they need to draw it at a lower age in order to meet those cash flow needs. Another factor is the amount in other taxable registered accounts. So the situation that is very common is you have a large RSP account, you might have some non-registered money, and you have to make this decision about CPP and OAS. And what you could do is you could delay, if you have enough other money you can use, you can delay it out to age 70 or closer to age 70 and draw registered assets. What we do when we look at our software that we use to actually manipulate all of this data, which is basically a giant financial calculator, let's say you didn't draw any income, you started your CPP and your OAS at the normal time, so let's say 65. And then you look out at age 72 when you have to take your minimums on your RSPs, it now puts you above the threshold and now all your OAS is getting clawed back. That is not maybe the best situation. If a person could, in those years, let's say they retired at 60, those 10 years, they may draw some of their registered assets in that time frame, and they may start CPP and OAS at 70 to have that base level of income. The strategy in that is different for different people because it also depends on what we're trying to do. Are we trying to get a person more spendable money in their lifetime, or are we trying to get them a higher estate value? When we can't pick when you're going to pass away, we can't decide on longevity. That's something that happens. We have no control over it. We can look at taking CPP and OAS. If you take them at the younger ages and you pass away younger, you will have received some funds. But if you pass away younger and you've delayed, you won't have received much. So some people just don't like the government to, if the money's on the table, they want to make sure that they get some of that benefit that they've paid their whole life into. Someone that has a very strong concern with that, where they feel like they're getting ripped off if they pass away too young and they started too late, that is one factor to consider. The other thing to think about is what is important to the person. A high concern of a lot of retired people are that they will outlive their money. They are so concerned about outliving their money. They're not concerned with passing away younger. They're more concerned with outliving their money. So when you look at that and you have these benefits that are out there that can be delayed and have an increased benefit and have inflation built into them, it helps with that fear of outliving their money because they have this steady base income that all the way along that they don't have to worry about outliving. If people already have a defined benefit pension plan, they may not want to delay all the way to 70. In their case, it may be that they have a good defined benefit pension plan through work. So that amount is giving them that base guaranteed level, and if it's indexed, even better, all the way through, that they're not as concerned about the CPP and the OAS. And even in that case, delaying it might bump them up a bit too high and have a clawback anyways. So in those cases, if you have a large defined benefit pension plan already, you might lean towards taking it a little earlier and consider what adding a higher OAS and a higher CPP check to that defined benefit plan, what that's going to do as far as the OAS clawback. Because you have to look at whether you're going to lose it anyways. So someone that's working at 65 that starts OAS and they're earning a decent income, they're going to lose their OAS anyways. So you have to think about the different rules within the structure of it and think about how your actual income mixes with that. And then also add to it your feelings around what your biggest concern is. Is your biggest concern making sure you get your money out of CPP because you paid into it your whole life? Is it that you're worried about outliving your money and that's a risk you're willing to take if you were to pass away earlier? Is it better to have a strategy for reducing some registered assets, or is it better to have a strategy of using non-registered assets during that time period before 70? And do you need the funds? These are some key things to think about. When we think about drawing income in retirement, we do like to take less flexible income streams first, such as locked-in RSPs. With the changes that have gone on with CPP and OAS, it is an inflexible income stream. However, because of those changes they made in penalizing so much for taking it younger, it's made it so that it's a much more complex issue. It's not as straightforward as it once was. And some people, the estate value is the most important. Remember, when you're calculating an estate value, you have to look at different ages that you could pass away. So what may be good for one age may not be good for another. So you have to make assumptions in when you calculate those. When you look at this question for yourself, the big things to keep in mind are, number one, are there ways that you could lose it completely? And are there things that you can do to offset that? For example, if you turn it on, you start it, make an RSP contribution to get your net income down. If you have a defined benefit pension plan that's really large, look at taking it at a younger age so that the payment's not as, you take it longer, but the payment's not as high, but you're taking it for a longer period of time. That'll help even that out. And you think about the things that matter to you most, the things like your number one retirement concerns. Everything can't be a priority with retirement. You have to look at the biggest concerns that you have. So you can have the concern of, I want to have a lot of money to spend in my lifetime and I'm not that concerned about what's left in the estate. Or you can have the attitude of, the estate, I want to leave this legacy. I want to have money that goes to all of these places, and that's most important to me, that I leave that. So you have to pick what is the priority. You have to look at your beliefs around certain things, like making sure you get your money out of the CPP program, and then make your decision based on that. It is helpful to run scenarios because it's not, you can lean to one side or the other, but when you actually have numbers to go with, it makes it a lot easier to make those decisions.